Yeah, so we can start, I think. Yeah.
Sounds good.
Yeah. So link is working well. I think it's fine.
Yeah, I see 16, 17 people are coming in droves here.
Yeah.
Hey guys, happy Friday. We're just letting a couple of attendees get in here as the link was not published quite yet. So just giving it another minute to let people get in. Thank you for that comment. Sounds like everybody hears us clearly.
Okay.
Yeah, why don't you begin, Dennis?
Yeah. So yeah, welcome everyone. I think it's quite an interesting weekend. I think we just had in Germany holidays, and I think you guys here in the US have a holidays coming up, so it's going to be a very relaxing weekend overall. Let me just I just do a quick sort of intro just to the actual sort of event and to all the participants, and then we can kick off. I'm Denis Rusinovich. I represent the mining operator, a company DDH, and I also one of the co-founders of this networking group we originally set up in Berlin last year in August, where some of you we met originally. And from that on, basically, we're just trying to do some regular sort of connecting with guys from industry, from a mining community, as well as guys who actually work closely from a trading sort of side and any other sort of angles that can sort of help this whole ecosystem develop, in more sort of transparent and professional manner. So let me just quickly pass the intro to everyone, just to give a little sort of overview of themselves. I think, Neil, we can start with you.
Sure. Thanks for that, Dennis. Thanks for putting this together as always. Hi, everybody. Neil Van Huis here again, partner and director of trading here at Blockfills in Chicago. Blockfills is a financial services technology and trading company that provides liquidity, execution, and clearing of digital assets to institutions and professionals. One of our main business lines is credit to cryptocurrency mining companies, whether those are in the form of collateralized loans or structured products. And we're here today to continue to work with, like Dennis said, many other professionals in the space to provide the proper financial solutions to the next gen mining.
Yeah, I think it's Daniyal. I think you can.
Yeah. Hey everyone, my name's Daniyal Inamullah, go by D. I'm a VP of Capital Markets at Cred Capital. Cred Capital is a capital raising and asset management company for digital asset companies. Currently, we're working on some pretty innovative products in the cryptocurrency mining finance space, primarily thinking through securitization and very traditional and also non-traditional ways to finance mining companies. And Dennis, thanks for organizing this today. Happy to be part of the panel.
Yeah, thank you.
Hey guys, this is Matt D'Souza. I'm the CEO of Blockware Solutions, Blockchain Opportunity Fund, and Blockware Mining. We're pretty deeply involved in the mining space. We distribute ASICs to the US. We have a research arm, we have a Bitcoin pool, and then we self-mine in the US. We offer co-location services as well. So our main offering through Blockware Mining is a hosting facility that we have in Kentucky. We're able to get US miners up and hashing within 48 hours as we have hardware on site. And we offer institutional scale rates to, of course, institutions, and as well as mid-size, smaller miners as well. So just bringing those opportunities to get any miners in the US to economically mine within the US. So that's kind of our goals. And now kind of coupling with the rest of the panel, how we can get access to debt financing to these miners, whether it's collateralizing mining rigs to kind of scale out and expand the operations of these miners.
Guys, that's a sort of a proposal to push the discussion into a different direction, because this is very, let's say, complex matter, and I think it's we can go deep in every single sort of part of it. So we can sort of divide it into sort of groups. I think clearly, let's say from a perspective of financing, we clearly had the traditional sort of instruments which were originally available to miners, where people are trying to link into a BTC as a collateral. But I think this is what recently has been it's good that it's picking up. I think where basically we can look at alternatives, and I think this is where we basically want to have your comments from your side as you see the market emerging, where we can use a different type of collateral, where, as you say, basically the hardware can be used as well. And then we can move on into sort of our sort of structured products. I mean, obviously what we saw in the recent sort of releases on some derivatives instruments for the hash rate and the difficulty. This is something which is a very interesting topic for everyone. And just in general sort of topics on, let's say, the treasury sort of risk management for miners, because I see, for example, from a personal observation for post-halving, I mean, what we saw, that clearly there's a big, let's say, the hit that happened on the cut on the rewards after the 12th. I personally see, like on a daily basis, we're observing, and we already managed sort of to recoup, I think, the overall, let's say, decrease, at least for us, we see now it's only 30% from 11th of May. So basically, we managed sort of to offset part of the losses with additional sort of I guess as more miners leaving the network, and I think what was anticipated. But at the same time, want to cover is your take on actual the price, because I think at the end of the day, we're all discussing the different things, you know, the hash rate, the difficulty, but a lot of things that kept a lot of miners, as I say, the zombie mining, all sort of generation for hardware still alive, and I think they gradually leaving the network. So let's start. I think from the financing options. I think this is a really good things that I'm sure that each of you basically have experience and actually that you're working on, and we can elaborate and discuss it. Neil, if you want to start, yeah.
Sure. Why don't I start there? So yeah, to Denis's point, there's a lot of products that have, well, I don't want to say a lot of products, but there's been a lot of opportunity for cryptocurrency mining companies to manage risk and manage their CapEx through collateralized loans in the past. Those are very, pretty mature instruments at this point. Our business alone did hundreds of millions of loans of that sort in the last 12 months. And so, I think that space has kind of matured out. Now, as we've come into the new cycle, post-halving, we've got new gen equipment. There's maybe two types of future use of products. One is, we've got individual mining companies that have been around for a couple of years that, have maybe chosen to collateralize some of their future growth with Bitcoin, but they want to scale larger amounts with new gen equipment that they've got to compete at a higher level. Now that there's a lot more mining power coming on, and so we've got those types of clients, and then I think we've got the clients that are coming into the scene that haven't maybe been mining 2 or 3 years, that maybe planned to come into the scene at the post-halving, right, into the new cycle. And so many of these groups are credible financial institutions, credible technology companies, credible mid-level organizations like Matt talked about. These are all people that are not looking to be bad actors. They're just simply in a different position than guys that have been doing this for 4 years. And so they would like access to capital to finance for 18, 24, maybe even 36 months, the purchase of their equipment and the collateralization of their operation at at tier 1 centers. So I think gone will be the day of guys that want to put a lot of expensive mining rigs on a Chinese riverbank. You know, I think they're more interested in putting them in a facility of high quality that is managed by people that have been in the space for years now, that have seen, you know, different things across different cycles of hardware and difficulty, right? So I think that's what we're seeing, and so those products need to advance, and so there needs to be some sort of a structured financing component. And so really what we're focusing on is either an instrument that collateralizes equipment, and maybe even potentially some portion of that in Bitcoin as well to buy down rates, or we're looking at basically structured partnership agreements at the data center level. So if a mining client wants to come in and do a 20 megawatt or more build at say, you know, one of the top data centers that's available, you know, we can basically get a deal together with the data center. We understand the cost of doing their business, how they're going to scale, how fast they're going to be able to scale, and we can look at all the financial aspects of their operation. And when that happens, we can model out a structured financing option that gives them access to, you know, good rates for good terms, and know that they have a very high likelihood of success. So those are really the main things that we're working on right now.
Daniyal, do you want to add to that? I mean, from Cred Capital side?
For sure. And Neil has done some really incredible work. He's, you know, given me some insight into his models, which has been really helpful on our end as well. So Blockfills is doing some pretty cool things in the mining space. I'd like to step back and maybe take a different angle to this, and just focus on sort of the genesis and the advancement of cryptocurrency mining since the beginning. I mean, you have to consider, like, you know, 10 years ago, people were mining Bitcoin on their laptops. And so we moved to GPUs, FPGAs, and then we started this, you know, crazy ASIC battle that has lasted for a long time. And as you see sort of the transition of the global industry itself, you also see changes in financial innovation. So what I mean by that is initially people were essentially venture capital investors, where they were throwing dollars, and basically it was a race to chip design. And that has advanced quite considerably if you look at, you know, for example, the most recent ant miners that have been released, which just have incredible efficiency relative to prior products. And we've gotten to the point where chip design, the importance of it is declining, and more important is becoming other elements. For example, having appropriate power contracts in place, making sure your infrastructure build is fine-tuned, which is what Matt works on, for example, in terms of sourcing and design. And I think going forward, these are going to be incredibly more powerful when you scale the industry. And as a result of that, you're seeing these vertical integrations. You know, Neil pointed to, for example, data center projects. So you have these large data center companies that are saying, hey, we have a better way to monetize all this energy that's flowing through our infrastructure, Bitcoin. And in order to do so, you really need these large, massive infrastructure builds that are really hard to finance, quite honestly. And they're extremely hard to finance if you're using a traditional collateralized model that is really old at this point, and outdated. So, you know, we have to break the mentality that balance sheet collateral is the way to scale the industry, and that balance sheet collateral, what it really is at the end of the day, is credit enhancement. So, you know, we feel that it's beautiful because it's really pure capitalism in a sense, that you have sort of the birth and then the advancement of the industry, and it has a direct implication for the cost of capital. So you're seeing initially these projects were all equity financed. Now people are raising debt just based on their balance sheet and operations. And so I think that's where a lot of the innovations are going to be focused on is project finance, because you can really have predictable cash flows and really lower your cost of capital in a sense there. And second is moving from a collateral focus to a credit enhancement focus over time, which prioritizes underwriting as a concept in the cryptocurrency space. So that's some of the projects that Cred is working on and trying to push forward today.
Yeah, I mean, from our end, we've Blockware Mining with one of our close partners, we closed out on one of these debt deals. We closed out on $1 million one, I think 3 or 4 weeks ago with Arctos Capital. And and they made it very smooth. They're great partners, and they collateralize mining rigs. So it's really about, it's a learning curve. People being able to get comfortable with, number one, it's an education on the industry. So what is Bitcoin? What is Bitcoin mining? How does that work, right? It's very intangible to a lot of different lenders. So they were able to, get educated and understand it. And then from there, understanding how the system works, how is this mining operation getting their future cash flows? And then it's also a massive cost accounting problem, right? So what are all the variable costs? What are all the fixed costs of the operation? And those could be communicated and modeled out and shown to your lender to get them comfortable. And then they'll see that this is truly, Bitcoin is truly a commodity in its infancy. As it continues to mature, the risk is reduced. And I think that's kind of where we're at. I think we're at a state where the leaders in debt financing are stepping in. They understand Bitcoin. They understand where this space is going to be. And most importantly, they're comfortable. They're really comfortable with starting to lend to miners because they truly believe and have bought in that this is going to be around. So from there, they want to analyze what's the fixed costs, what are the variable costs of the operation, what technology are they getting into to reduce their default risk, and then with where difficulty projections of where difficulty is going, potentially a little bit projections of the price of Bitcoin. You can model out the future cash flows of the mining rig, and therefore, to a degree, you can model that out, have different expectations, and a mining rig is truly the value of its future cash flows. So this analysis, I think a year ago or several years ago, it was very intangible. And now when you throw in these models, when you deeply research and understand the space, when you understand that as margins go down, inefficient miners shut off and difficulty adjusts, and miners that are efficient, their margins improve. If your borrower is in that bucket of more efficient miners, I think lenders are getting more comfortable, and they could get more comfortable towards extending debt to miners and taking the duration risk over a year or two. So that's what we're seeing. We're seeing a lot of different different very credible institutions step in and want to start extending debt to miners and willing to collateralize the mining rigs. Because if you're a new mining operation, you don't have Bitcoin to collateralize, and ultimately it's kind of just margin, right? So the shift towards collateralizing mining rigs and these hard assets, that's really what's going to help scale out the mining industry. And we're seeing a lot of different lenders step forward and get involved. Neil's one of the leaders in that. So it's exciting and it's great for the industry.
It's interesting I wanted to sum up, let's say, from the sector perspective, because from our personal experience for the last 3 years, like from a mining operation, obviously we were building up, trying to access more towards the capital markets, because this is the only option was available, let's say back 3 years ago, because people were trying to do RTO placement. And but this mostly was let's put it this way, it was more retail investor focused model. People trying to raise money from a general market, and it's also created a lot of reputational damage, because a lot of bad actors actually went into this way and actually damaged. But what's interesting to see, and this is what I want to actually add to you, basically, to also just to highlight your observation, what I see that there is currently two different developments. One thing is basically the miners, as we see them, let's say 3 years ago, the model changed, because currently you have guys who are very specialized, like a big either energy providers with hosting capacities, who usually come with traditional data center background and know how to operate very intense big operations. And then you have guys actually coming from a side who actually see more to provide in the different financing over solutions. And actual mining in itself, it becomes only in a way almost like a hosting that you have in traditional data centers. You have a hardware you could put on a shelf, and basically the derivative comes out of that. The Bitcoin, this is where you need to address it with the market and other risks. And this is your basic business model. This is the one thing that we see. The other thing I think is it's very interesting, and I think this is the great thing that we see mostly at the moment in the North American market is actually the debt financing. And I think this is, I guess, would be the main driver for industrial scale operation that will be evolving in the next 18, 24 months. It's actually will be these guys who actually have access to this financing, because this is the cheaper option, because everything else was financed by equity until now. But also I think going forward with all the developments, I think this is clearly a new trend. So it would be interesting to hear your sort of views on that.
Well, if I may start, I think that all three of you have really kind of built the perfect lead into this conversation, because each one of you have brought up, the methodology of educating, the next gen participants, right? And so I had a great conversation with Matt Carson this morning. I'm sure everybody knows Matt Carson pretty well. We were talking about just in North America, what's happening, as Denis put, and then we both just kind of looked at each other and we're like, okay, well, so many things that are happening in the United States, it's more than a Bitcoin play. It's an energy play. And that's something that's kind of special about the United States with these data center projects is we've got very, plentiful power. We've got very cheap power in certain regions. And so the data centers themselves that are creating this infrastructure for the underlying mining companies, they're doing it not just on a Bitcoin and a computing power play, they're doing it on an energy play. And so for people that want to come into the space and get educated and get, put money behind, financing mining operations, getting their head around that play, I think is also important. That you're not just investing in an infrastructure and an asset class and hard assets, but you're investing in high power computing, which is clearly the future, and energy. And that's where your structure is to build a basis for an investment, right? And the rest is, let's look at the model, let's see what this person's chance of being successful is. And that's what we start doing it and putting those input costs in. So it takes a while to educate people that are not from this space to look at the decision criteria that takes place for a mining company to actually deploy capital to run their operation. They've got to look at their cost of energy. They've got to look at the machine type they use. They've got to look at their cost of debt. They've got to look at how quickly that they can get to market at that facility that they're at, how quickly they can get machines sourced for their project specifically from overseas to North America. All of these things are just this great project plan that if it doesn't all align, and somebody swoops in at that data center and takes that 20 megawatt spot and deploys faster than you, you're out of luck. And now you're 6 months further down your line. So all of these things are pretty interesting as components. And I really think that if you look at the traditional space in data centers, we talked a little bit about that earlier as well. You look at like an Amazon or a Facebook or a Google or whomever wants to come into the space, they might buy out an entire data center to do cloud hosting, right? And they might pay 6.5, 7 cents per kilowatt hour, at those normal rates. And they might do it to the tune of 50 or 100 megawatts. Now we're talking about one company doing a project for 50 or 100 megawatts every year. And a facility is going to do, hundreds of megawatts of power deployment to support high power computing. So the paradigm of the economics of energy, totally come into play. And that's why certain sites are more opportunistic than others. And that's why we're really focusing on having a relationship with specific sites that provide specific economics to the end mining client to ensure that if we give them this product, which is a simple 24, 36-month financing term with a certain interest rate, that as long as they pick this machine type or this machine type and they go to this facility, there's no reason why they can't be successful. And so that's really kind of like how we're trying to standardize a product a lot like you would do like, you know, rated fixed income products or mortgage-backed securities in a traditional market. Standardize a concept, you know, build it, package it up, you know, maybe resell it at lower rates and rinse and repeat, you know, that sort of thing.
We go in the same order. I can take this next. Yeah, I mean, Neil touched on a lot of awesome points there. I would just add a couple of other items to just debt financing for mining in general. One is that the underwriting criteria need to be updated. I mean, historically, it's been primarily the amount of collateral you can provide and then the history that you build with a lender, which takes time, effort, money. And it's not wholly really dependent upon the infrastructure that you have built. And I think going forward, there's going to be a lot more credit giving to operational efficiency, you know, underlying contract structure, whether it's power or, you know, equipment acquisition, whatever that may be. And then also you have to think about just the vertical integration of companies in general. I mean, we're all starting from, you know, for example, Bitmain has this big approach where they're a designer, they have pools, they have all these internal operations as well. And I think you're seeing sort of more companies in the US start to take, in North America in general, start to take that same approach where there's a competitive disadvantage if you're not a chip producer. So I think more and more companies are going to start aligning with sort of in a vertically integrated fashion, whether that's through outsourcing or building their own departments, which is going to create more opportunities for underwriting different elements of a company, which I think will be pretty sweet moving forward, just from a lending perspective. The other thing is that lenders need to be better. I mean, Cred needs to be better. Everyone else in the industry needs to be better as well. And we just need to get smarter on how we can really look at an operational flow of a company, identify where in the balance sheet or where in the P&L we need to improve and to help a company. You know, there's been so much focus on AUM, which is great because that's how you make money, but it doesn't really give a lot back to the industry. So I think lenders just in essence need to be better in that space as well. And a critical component of that is investor education. You know, the name of the game used to be, how can we get parties on both sides to you know, buy into a deal and operate on a spread perspective. Rather, we need to take more of a balance sheet approach or try to create a product that we can bring in third-party leverage to the industry from traditional institutions. That's the name of the game, to reduce your cost of capital. The other thing is that financing terms need to be updated as well. You know, we saw, obviously, you know, I made my comments on collateral, but even this recent trend on equipment finance, I think more going to the future, we'll need to morph into production-based finance. Because if you look at, you know, traditional REIT structures or MLP structures for energy companies, that's really how they scaled. I mean, the gold mining industry itself in the 70s began to scale when people started to note that project finance is a concept that can scale an industry with cheap cost of capital, while also being able to manage risk in a smart way, and risk meaning in terms of just the volatility of gold prices. So I see ourselves really at the precipice. I mean, this is 1973, gold has been unlocked, and you know, we're moving forward to try to give birth to a new industry. And so I think that will hopefully potentially go. I think equipment finance is critically important today, but as we move towards production-based finance, I think that's really where you see scale being built into the industry. And then finally, you know, public companies are an indication of the general market. You know, we need to basically provide knowledge to investors to the fact that, you know, Bitcoin or investing in Bitcoin is not your only option to get into crypto. There's fixed income instruments that need to be created. There's a whole other side of the balance sheet that we need to focus on. You know, public companies have, I'm talking about mining companies, obviously, you know, you see report after report about mismanagement, operational mismanagement, and there's a reason for that. 2018 happened. But moving forward, it's going to be a general barometer for how the rest of the investment and finance community views mining in general. So I think there's a lot of companies doing really great stuff. I mean, for example, there's a layer 1 deal out there that, you know, there was a big Forbes article about yesterday, and I think that's getting a lot of attention just based on, you know, it's backed by a whole lot of great VCs, and I think that's going to be really the start. And there's plenty of other companies out there as well, but this is just one quick example of a rebirth of scaling an industry through debt. And that's where I want to be. So I'll kick it to you, Matt.
Yeah, kind of, I think you bring up a good point with which companies are going public, right? If you keep delivering lemons to the market wants nut, right? That's so reflective. Those are the ones that go public are reflective and are getting projected on the rest of the industry because they have the spotlight on them. So there's some good ones. You know, I know Riot they're doing very well. I think they're a well-managed company. So we need more companies like that, more minds that are leaders, that do things by compliance, and that are wins for investors, right? Investors need to get rewarded for their risk. And when you have a bunch of, you know, what we saw in 2017, a bunch of reverse takeovers, and these buyouts that went public, and also into 2018, and it was a bunch of lemons. It wasn't real, true operations, but they're getting the spotlight. They're getting the media mentions, and those bad actors are getting projected on the rest of the industry, and that keeps capital out. And it's critical that capital comes in, because that's how we grow the space. That's how institutions get involved, and it's just a wider breadth of participants, and that's super healthy for a market, right? So just wanted to add a little note on that.
Well, I mean, this is it's quite an interesting thing, because you see we're gradually sort of going to this the listed pool, but at the same time, what Daniyal mentioned, it's what thing that clearly it's still in development, and I think we guys covered it on previous also some discussions, is that there should be a bridge. It's almost like a merchant banking that actually has an expertise, because when we go into this type of sort of project finance assessment, because as you mentioned, basically in terms of traditional sort of mining, I come from the traditional banking, which is a project finance related, and I worked in the gold copper sort of mining sector. And I think what I see the similarities, obviously, if we take away the actual the Bitcoin parameter, the actual approach to that, it should be a similar way, because, and I think this is what at the moment I think it's building up, but still missing, and is that we need more, let's say, the interlink that between the professional investors and the guys who actually know and can make an assessments, because I mean, all of this is the credit risk assessment. You know, you need a specific site, you know, a specific hardware, and then to see how you address all these parameters that basically Matt mentioned in terms of the models, you know, how you model in the hash rate, the difficulty, and the price. And I think this is all of it shows that there is going to be another growth in this sort of let's call it merchant banking for the miners. They should bridge the actual sector and the investors. And the other thing I think it's interesting, and we just roll into the other topic, is actual the structured products and derivatives, because I think this is an instrument to addressing the risks. And I think that's something that we see some developments. It would be interesting to see like all your sort of all the developments you see now over the last like few weeks. I mean, with FTX, basically with Yoda did a good developments. I mean, what's your view on that? I mean, the market is only picking up, I guess.
It's super healthy. I mean, you get all the things we're discussing, you know, Dennis, like take yourself back to 2016 or 2017. You couldn't even, I mean, I was thrown out of Chase in 2016 or 2017 just for my Coinbase account, right? So think about the services that were available, and that was as a retail customer, right? So you couldn't even, no bank, no one would touch you with a 10-foot pole, and now the CME's trading futures, and they have options. A lot of different financial institutions are getting involved, and they're offering financial products and derivatives. It's always going to start with, you know, some of the startups are getting involved with the derivatives hedging. And what that does is it creates institutionalization. You know, I kind of point back to Bitcoin is a commodity in its infancy. When you analyze other commodities, oil, soybeans, gold, the individuals that are the suppliers, the miners of gold or the oil drillers, they hedge out a year, maybe more, right? They have futures every month laddered out for a year so that they have smoother earnings, right? And that reduces volatility in the commodity, but it also allows these suppliers to have far more certainty in their future cash flows and their margins. And when you have more certainty, then the market is more willing to lend and participate, right? So these futures products, these derivatives, it allows you a better chance of locking in your margins and your profits, and now you have more certainty in your future earnings, and you become, it's a lower risk, you're a lower risk investment, right? So that's what we're seeing right in front of our face right now, between difficulty hedging, between options, between futures of Bitcoin. It's maturing the Bitcoin ecosystem, but it's also producing or providing more certainty into the, into the future cash flows of miners. And that's gonna be far more attractive for institutions to want to lend to, as well as invest in.
Yeah, I think Matt really hit on some nice comparisons that I always like to use, because my entire career has been in derivatives trading here in Chicago, right? We've got these huge exchanges, they manage trillions of dollars of trading every year in every major asset class that's out there, right? And I got my start in fixed income, and then I moved into commodities. And what I learned along the way is that liquidity begets liquidity, right? And it's just one of those things where, like, if you build it, they will come. And what we've done here is, to Matt's point, we've seen some advancements that some institutions are only willing to go so far, right? And what you would normally see in a traditional space is you'd see CME Group leading the way on every single product that gets launched every step of the way. And behind it would be ICE, or what you guys probably look at as backed, right? But they're ICE for a long time. So normally these guys would be taking every single step to advancing a market. In crypto, it's a little bit funny because you almost have to reverse that. The guys that have been doing things that other big institutions would not be willing to do for several years, those are the guys that are innovating, and they're attracting everyone else. So it's from a sector standpoint, it's a great time to be involved and be a part of it and to build a business in it, because all of these people are going to come, and they're going to come to you to see what you're doing about it and what you're advancing, because they don't want to necessarily be a first mover. They don't necessarily want to initiate a new contract on a exchange like CME just to have no one trade it. I mean, CME started doing that 15 years ago, where they were launching a product that would trade hardly any volume, and then they'd shut that product down. And they were doing it because they couldn't grow market share any more than they already had, and they had to create the next hybrid product one after another. But what we have here is we've got this still, it's a rapidly maturing space, but it's an immature enough space where when you build something that has some thought process to it, you're able to build something that can expand the ecosystem in a great manner. So I think that when you talk about the hash power contract that FTX brought out, I think it was like super interesting because those guys can roll out product almost faster than anybody else. And that's what they're really good at, right? And what they did is they said, let me put it out there so that everyone wants to talk about it, because everyone seems to be talking about it, but there's no instrument being traded on it yet. So let's put it out there and let's let people trade on it. But that's a step in the right direction from all these conversations that have been happening and what we're all trying to do. And if you look at BitUda, they've been able to get a couple transactions done. What we're trying to do with several of the people on this phone call is get our transactions over the finish line that allow us to show this other new product has made it onto the scene. And what could be done with the hash power contract if, let's say, a difficulty instrument came on the market and was a liquidly traded instrument. So, swaps, derivatives contracts, etc. Liquidity will come if liquidity's there, right? And so if we can start there and we can bring some of these debt instruments come in, those debt providers will come out and they'll start hedging in the market, and all of it comes full circle. And so it takes some time and some building, but just like Matt said, there's so many things that have come from traditional asset classes for so many years that we can apply here, and that in the early days, no one wanted, because they said decentralized, decentralized, decentralized. Well, liquidity is centralized, generally speaking. And so what we want to do is we want to try to keep this a Bitcoin market, but bring tools over from the traditional segments that can allow this market section to expand.
Yeah, agree with most of their comments. I think one other factor that this will lead to as a consequence is that lenders, traders will take more of a prime brokerage feel when it comes to mining clients, meaning you need individuals that can smartly package lending plus derivatives plus the appropriate corporate structure to really optimize the cost of debt. And I think an important piece, what you just noted, Neil, is the concept of credit default swaps as well as a derivative product, which is essentially insurance at the end of the day, doesn't exist today. And so at the beginning, when I mentioned credit enhancement as a concept, rather than departure from collateral as a concept, as we trend forward to more production-based concepts to really scale the industry, they will just become incredibly more important. So, like looking at traditional metrics like EBIT coverage ratios or debt to equity leverage ratios, and then layering on top of that the appropriate amount of derivatives hedging, that's where the full package will really make a meaningful impact. So for us, for example, we're looking at partnering with companies like Blockfills that are experts on sort of the derivative side, just by example. When we go to these clients, and sort of this partnership approach will really help grow the industry. I mean, crypto just in general and on the finance side grew so fast over the last couple of years, and they grew really in specific niches. No one really grew outside the bigger names that everyone knows. No one really grew from a vertically integrated approach. I mean, even Coinbase primarily only has custody and exchange products. They don't have 100 different products like a JP Morgan does. So I think that as these partnerships build, you'll see more M&A in the future as well, which I think will be productive. You saw sort of the Volt acquisition from Genesis yesterday or a couple of days ago, whenever that was. And I think moving forward, you'll see a lot more of that flavor, which I see as a huge tailwind to the industry.
Yeah, I think it's you guys. I mean, the way you capture this, I mean, what I see, let's say, that we're going to have let's say, the financing provider will actually start determining more, because clearly, I mean, when you come to a discussion of financing, I mean, you want to see how you're addressing the risks. So, and I think this is where the important factor actually, from someone who understands the crypto and actual the Bitcoin environment and the mining environment, I think it would be vital, especially like to give a comfort to the eventual sort of investors, that actually you have a financing and additional sort of derivative products built in that limits some sort of risks, potential risks, and sort of gives much more stable sort of structure. And this is what Matt said about the traditional mining, because at the end of the day, I mean, the miner, I mean, it's if you look in purely on the miner who's basically providing this infrastructure, I mean, he should see how he hedges the risks, especially if he's actually was financed not by equity, but by debt. And I think this is actually will be an important factor. I think probably would be great to see how it develops now. And I'm sure that this is something which will create a big drive, especially for large deployments, because I'm sure these large deployments will set up a benchmark that how the mining sort of communities should start adapting the new products. So yeah, it's,
yeah, I definitely think if you look at like the market segment right there, I think that it's really interesting because if Bitcoin prices do go up, right, quite a bit for whatever reason, it becomes a really interesting situation, because you've got all these guys looking to do large scale builds right now, right? A lot of new players, a lot of cash coming into the market. And then, if you look at, Matt's company and you say, look, if you want a company that can provide you a number of solutions to get like turnkey hash power in the United States, as people are starting to geographically diversify their mining operations, I think that you're looking at guys that can create entire businesses and entire market segments inside of the larger segment, right? There's an incredible amount of difficulty in organizing, entities from overseas that want to come and do business in the United States with plentiful power and cheap power. And there's going to need to be guys like Matt and his team that say, listen, we know what we're doing. We've been doing it for a while. We're successful. We've got our own operations. We can do plug and play hash power. We can sell you machines that are already turned on. That's really interesting. And from a financing perspective, that mindset is actually really interesting to me in general as well. And the reason why is the biggest risk in any one of these financing scenarios is someone defaults, right? And the last thing that any of us want is a default in our portfolio. It just doesn't look good to the portfolio. But what I think that can be done really interestingly in the crypto space that might not be able to be done in many other asset classes or quite so swiftly is, let me give you an example. Mining company ABC gives some machines to Matt. Matt, Blockfills finance them. Matt's running their machines in his operation, right? And that mining company just overspends, overleverages, defaults, right? Or goes through, a tough time where the market is just, stagnant in price and they just can't hang tight. Well, then if we know they're going to default, what we can do is we can find a number of miners out there throughout the world community that want access to US-based hash power. And we can sell and transfer those assets to that new company. And we can allow them to have turnkey hash power and the loan just keeps getting serviced, right? And these are things that really provide liquidity to these scenarios to make sure that if it's not this company, it's another company. And I probably have a list of 10 clients that are always looking for turnkey solutions, and it's very hard to get because somebody's got to do a capex to put another 20 megs of available space at their data center, and that's already spoken for by somebody who put the capex money up, right? So you look at like what Matt's doing and other guys like Matt in the space. It could become an interesting market segment for the financier if you don't want to go and do 20 megawatt builds all at once. So I really like the layers of what can be done here in this space going forward.
And I think like the next step to that, Neil, partnering with the right people and kind of essentially vertically integrating together, where it's that turnkey solution where Blockware, Blockware Mining has that facility, has the machines, has the track record of managing the units, the ability to cool, and then also being able to seamlessly, get the debt financing to the customer. And you guys are going to have track records on some of our customers, right? We can communicate that to you guys and understand once again who's low risk. And then I think you can get more creative, where if a miner already has, let's say 100 machines, and he wants to expand 100 more, you could collateralize the machines he already has and his new machines, right? They've all been at the facility. So there's really interesting ways to do it. So most importantly, it's equitable. We want deals that are equitable for the miner, as well as for the lender. And I think that's what, everyone in this space is looking to achieve together.
Yeah, I think it's very important that we see these developments where we have a developments on the secondary market, because I think this is what some of the issues people have, because I mean that you invest in something and then you can get out of it, because especially in the case of default. And I think this is actually the important development that's this whole sort of what we discussed. I think this is all development in this ecosystem will bring now, so that people will get a comfort that basically if there is a default, there is a plenty of other sort of players that they can pick it up, and you still sort of you don't run into some crazy exposure. And I think this is what people were worried about, that okay, we invest something and then there's a default, and what we're gonna do? I mean, how are we gonna go and find this farm, and how are we gonna deal with this? And I think this is where the market is developing now. I mean, so this is great. So I think guys, we have I think 10 more minutes. Shall we ask? Is there any questions? Just 1 second. Is there any questions that we should address? We had one about.
And Dennis,
Yeah.
Dennis, just real quick on your point. It's really going to be an effort from many players in the industry. Like when you were discussing default, there's, Blockware Solutions, we broker a lot of rigs. We understand the buy side and the sell side. We're basically one of the market makers for mining rigs in the US. So the ability to also have these different service providers and kind of discuss what's the liquidity out there, what's the secondary market prices out there, and giving that type of insights to miners, to the lenders as well. So you're right. It's really a game of information and getting the most reliable information to all parties. But yeah, go ahead. Let's field some questions. Any of the participants want to type in a question through the chat? We'd love to answer those.
I think I did see one pop up about it, checking the recording later. Dennis, you are going to post the recorded session. Is that correct?
Yeah. I just already replied. So basically, we'll in a couple of hours it will process and I will post it in the video channel, and I think it could be shared in over posts again. Yeah. So for people can catch up on that.
Any other? Looks like
we got some.
Yeah.
Are there capital pools being put together to develop or fund some of the products Neil was talking about? So are there, Neil, this is addressed to you.
Yeah, absolutely. So number one, we definitely have what we call buy side flow here. So, as I talked to like the FTX guys, we were talking about, well, there's a lot of guys that want to sell hash power, right? They want to finance their operations, but is there a buy side for that? And I actually, I have plenty of people on the buy side for this. We're on the buy side for this, and we're actually looking to expand those pools of capital right now. I mean, Cred Capital is doing just about as much as anybody can do in this space to find proper channels and securitizations of products so that we can get access to large-scale financing in a short period of time. So we absolutely do think there are capital pools out there already. No, we don't think, we know. And then we also think that we can grow that rapidly over the rest of this year. And we're already working on it. So that's my take on it. And I'd like to give Dia a second to comment on that as well.
Yeah, we are one of those capital pools as well. I think the structure of those capital pools will change going in the future. One of those examples, which everyone was just alluding to, is in the case of default, what happens? Well, traditionally the options are, finding liquidity in traditional exchanges. So retail investors or institutional investors that go onto their E-Trade account and buy a bond that's fallen in value, but they may have some positive hopes for, or a distressed fund. A distressed credit fund, I think, will probably start to pick up in 2 or 3 years as some of the inefficient miners get out of the game and need to be recapped, essentially, to push the industry forward. So there's definitely capital pools forming. And I think this answers another question that I see on the list that just popped up. How do miners cover their operational costs that are presumably in fiat currency? So historically, it's been sell your crypto, collateralize your crypto to get a loan, or equity financing. That's how people have traditionally covered those operating costs. I think we're moving towards a format where working capital loans and sort of equipment-backed loans that Matt mentioned at the beginning, those are becoming more and more commonplace. So you'll see a diversity in how to finance that operational cost flow.
Yeah, go on.
I was just going to say, yeah, I totally agree with that. And with our products, the way our instruments are set up is that in the event that you needed to sell BTC or get collateralized loans, yet further on that, we're basically a full service financial services company on the crypto side. So if you've done a debt financing with us as an agent on that, with any of our partners or us directly, you can come to us and you can say, hey guys, I need to do some, BTC collateralized loans, and we can source that for you same day usually. If not, if you need liquidity, Blockfills runs a full electronic trading platform and OTC business where we can execute your transactions immediately and get you liquidity. So please take it away, Dennis.
Yeah, I just wanted to add, I mean, it's clearly one, let's say, if you purely looking at operational costs, let's say on a month-to-month basis, the major cost is clearly the electricity, you know. And I think for miners, if we can go in sort of, it's a more active approach. If you do a conversion to a fiat, obviously, it's then a subject how you manage your trading strategy, you know, because of all this BTC volatility that we have. But what probably would be interesting is actually that if we have, let's say, the more sort of 30 days rollover, that way we can fix and at least sort of a capture part of the fiat basically conversion and to cover this, the costs. I think this is the instrument that probably will be coming into the market more commonly for miners, because I mean, at the end of the day, then you don't need to worry about the price volatilities when you're executing the trades if you have to. Yeah, it will be interesting development, as Neil said. But basically, I think it's more and more instruments we need for working capital, because I think this is the most important part, especially as we move along from this equity model that's been sort of run in the market. And I see that we have a question which is basically exactly corresponds to that. I mean, what's how much crypto investments has been in equity? Can the community support the size needed for debt transactions if incumbents are still not ready? Yeah, I think this is a very interesting part. I mean, because it is an equity story, was to date, but at the same time, I mean, the CapEx intensive exercises that are coming in now after halving everything, I mean, it's clearly a restructuring of the market, because the guys who want to raise a big money have to be sort of more transparent and more sort of prepared to deal with institutional type of investors. And I think, guys, I would love to hear your sort of professional sort of view on that.
Yeah, I mean, oh, sorry, go ahead, Matt.
I was going to say, just in terms of post-halving, these are some of the best times. The next 6 months are, just from like a market's perspective, the next 6 months are going to be the best investment opportunities. What halving is, it's probably going to be a 2 to 4 month bear market for miners with their margins. When you get a bear market, whether it's in traditional markets like equity markets, that's the blowout of all the inefficient and the laggards, right? So you know, and after the tech, the 2000 tech bubble, after the 2008 financial crisis, the companies that first IPO'd were the best companies. Those are the winners, right? Google IPO'd right after the tech crash. All the best, those are the ones that are going to get access. So all the inefficient miners, they're going to blow out, and the individuals that are the best and have the best rates, have done their due diligence, they're going to be the ones coming for debt. And it's going to be de-risked because they know what they're doing. So you're going to get your best opportunities to invest in these different efficient mines over the next 3 to 6 months, and you're going to be able to do it at lows. And it's at a point where you can't get yield elsewhere. Interest rates are low, and it's an opportunity for lenders, because they're going to be able to capture yield in the mining market. So I think it's the next 3 to 6 months are going to provide opportunities on both ends for the borrowers and the lenders.
Yeah, absolutely.
And just kind of, and just fielding that comment about what happens in defaults. Well, there's robust, you know, we sell a lot of peer-to-peer on the buy and sell side of mining rigs. So if a borrower defaults, you don't just have to mine their equipment. You can resell that equipment in the US. Remember, mining rigs are supply constrained. They're very supply constrained. Presently, the lead times on them are about 3 months. So there's demand for mining rigs. So borrowers could also take to service providers like us. That's what we do, but to liquidate mining rigs on the open market. So there's options out there, and those are only going to get more robust.
Yeah, that's totally accurate, and that's kind of why I mentioned that earlier. I think it's so important to work with people in this initiative. You've got to, like, you know, I want to work with Matt, because when I'm doing a financing deal with Matt, for a client of his, that I'm getting full transparency. I know exactly what I need access to and information. Everyone's, being open and transparent. And in the unfortunate event that a good actor defaults, and we don't want to see it, but in the event that we do everything we can and they just can't stay afloat, just like Matt said, we've got options on how we can deal with that. Guys can continue to service the loan payments if they're the lender. If they want to be a crypto miner, they can service the loan themselves. If they're Matt and Matt says, listen, it's a bear market, I like this opportunity, I want to service the loan myself, he can do it. If another miner wants turnkey hash power, they can do it. If another guy wants to buy equipment that's onshore in the US because he wants to do a deployment over at this site and needs a couple weeks delivery time, there's a lot of layers of option there. And that's what people need to get their head around in this space, that there's so much demand for this. And it's just to Gary's point, there's so much demand for this. There's layers of, I want to call it collateralization in all of this, or servicing the loan payments. And Gary, you're a pro in all this. I would say that from what I'm seeing, if I could get the guys that I'm talking to play ball at the scale that they want to play ball at, I think that we could service up to $500 million worth of loans in the next, 6 to 12 months. Now, what other guys are doing that have deep pockets as well, I'm sure that could be more than that, and I'm not talking to those guys. But I think there's billions in demand in this for the next 18 months, and we've got to see how that shakes out.
Totally. Well said.
Yeah, Gary, thanks for saying that question. We're going to get those incumbents to start financing our deals. It's going to happen in the next year or two, at most, I think. But the industry is just morphed so much. There's so much more investor knowledge. It's pushed by people that actually care about the industry, which I think is probably the most important. I feel like I think all 3-4 of us are very passionate about just crypto and Bitcoin in particular. And I think we're going to get everyone on board. I think most of the deals in the past have been more club type deals, which is great because it helped grow the industry. But now we're after this last halving cycle, I think we're really geared for success. I think for this industry, and you're going to see a lot of it coming up over the next couple of months.
Okay. Well, I think we're ready to wrap up probably. So thank you very much, everyone, for joining. Thank you, guys. Basically, it was a pleasure, as usual, to have this discussion with you. And we're going to be posting the video in a couple of hours, basically.
Yeah, that sounds great. Thanks, Dennis, as always, for putting this together. And guys, I'd like to do something with everybody on this thread here. And I'll check to Denis to organize, because he's really the leader of the pack. I've been thinking about making a Telegram channel about this little syndicate of all of us that are interested in, financing, talking to Matt about getting access to equipment onshore, talking to Cred Capital and Blockfills about, financing. I'd love for Denis to maybe kind of like put that under his networking umbrella, and any participants that want to be a part of that, we'd love to hear from you, hear what you need, and find ways to provide solutions to you.
Yeah, we'll do that. We'll do that, I think, today, tomorrow. So we're going to post it all across. Yeah.
All right, good. Sounds like a couple of hands are getting raised for that. So let's do it, guys.
Yeah, good.
There's the BD person.
Yeah.
Thank you, guys. Thank you, guys.
Great,
Thanks,
guys.
Everybody.
Thank you. Thanks, participants.
Bye-bye.
Dennis,
Bye-bye.
always. Thank you. Bye.
Thank you, guys. Bye-bye. Bye-bye.